I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Good morning. My name is Scott Redler, Chief Strategic Officer at t3live.com, and welcome to today's morning call. So if you're looking at some headlines, if you're looking at the overseas markets, you're seeing more red arrows. You're seeing more downside follow-through in what has been a pretty nasty, quick corrective process. You have Europe down almost 1% again, not crashing, but those days are starting to add up. And then you have the Nikkei down another 4.1%, making it almost 15%. And yesterday, our markets that tried to hold the 100-day moving average at 1770 in the first 30 minutes broke its immediate trend line, went down another 2+%, and now we're sitting in the S&P down 5.6%. So the question is, what do you do now? All right, and that all depends on who you are and what your process is. We started this year with two trends. Both have now been violated. So the question is, where do we go next, and what tactic do we use? And in the daylight today, with the futures up small after a big down move like we've seen, what I would do is I would just write down, you grab a pen, write down yesterday's low in every sector you're trading, and perhaps we get some type of red dog reversal where they push the market or that sector below yesterday's low, trigger some stops, get some more acceleration to the downside to then maybe get reclaimed. And then that's your tactical buy, and perhaps we get an oversold bounce considering we're minus 80 plus on the oscillator, which everyone's been talking about being so oversold. So when you're that oversold, being short is very tricky, but it doesn't mean you just dive in with two hands and start buying. Now, first things first, you take a look at the chart of the SPX with the spiders, and you will see here is the macro trend line that's in place. That doesn't come all the way down till about 165. Then you have the accelerated that was broken to 183, and then you also had yesterday at 177. Now I want to quickly just show you the weekly chart because this is the reason why everyone's very concerned. Because you look where we are. Bulls are jumping out of their skin, jumping, worried, like almost like the world's going to collapse. And look where we were a year ago. A year ago we were all the way down at like 144-ish. So with that being said, you really don't know what type of retracement. And that's after, obviously the low from 2008. If you also people thought I was crazy last year when I said we were going to take out the double top and go to 1700. So anyway, this is where we are. This is where we came from. So, there is some room if the market wants to get that volatility in there. And everyone's talking about 5 to 7%, 10 to 15%, 15 to 20%. As of now, all we know is this. So this is how I'm dealing with it. All we know is you had this upper level that broke. This was your spot to reduce risk. Tried to bounce. Tried to create a right shoulder that it wasn't even strong enough to really, bounce back. And then wound up going lower. So for today, this is your 150-day. You write down 173.83. See if the market can either push to it. If it holds it and bounces off it, maybe buy versus this. If it breaks through it, perhaps see where we go. We come back above it. You buy with the stop at today's low, and then maybe we get some kind of retracement. The 200-day isn't down to at least 170.94, and then the trend line is down here, so you don't want to start too early. That's why you want to do a level versus a level. Hopefully you got out of the way here, or maybe even got short, and now you get to figure it out. So I want to do the same thing with some sectors. The Qs. Qs also broke its accelerated trend line right there below the 8 and 21-day. Actually built a pretty big rounding pattern here, or some would say some type of head and shoulders pattern also. Just broke below, but if you look, the Qs are showing the best relative strength. The Qs are not even down to the 100-day. So with that being said, here is your relative strength. So the question is, will technology play catch up to the downside, or will it be a place to go to if the market finds its footing? As of now, all you know is this. You know yesterday's low. Yesterday's low is 84.07. Write that down. 100-day is right here at 83.48. And let's hope it doesn't play catch up because it's got a long way to go. And that means everything else that's showing relative weakness probably goes a heck of a lot lower. One of the indices showing relative weakness is the diamonds. Look at the Dow. The Dow, pierced its accelerated trend line here, broke below, tried to hold in there, and is already at the 200-day. So with that being said, this is the weakest area in the market, or one of them. So this isn't usually the first thing you buy. Maybe it's a two stretch, you get a bounce, but this is not where you want to put your money once we bounce. You want to put it in stronger sectors. But anyway, you look at the diamonds, 153.25. That's your low from yesterday. If we were to break below it and Dow be down 100 and everyone starts running for the hills again and we come back up and reclaim the 200-day, maybe that's your pivot to buy and you get some kind of reflex bounce. So that's how I would approach the diamonds. Same type of strategy in another sector. You have the Russell, the Russell, which broke a pretty long-standing channel, which typically not good. Hopefully you've been armed. We've showed this channel many times, and for most of 2012, it held. What did it do this time? Broke below it, hovered below it, then got continuation. So with that being said, it's not quite at the 200-day like the Dow, but it's not too far away. So with that being said, if you're trying to play the Russell, same type of strategy. All you know is yesterday's low. Yesterday's low is 108.15. It could either match it or it could break below it, and then it might even just get another wide range bar. You don't know. That's why you want to wait for it to make a low, buy versus that low. If we were to claim the prior day low, perhaps that creates that bottom tail, and then you figure it out from there. I'm not going to go through the same type of strategy in every other sector because it's the same thing. Everything basically closed on the lows. Something or some sectors are weaker than others. So pick and choose what you want to do. What I would do is simplify it because you can't look everywhere. Maybe, I'll show you one more thing, the XLF, which I think is important, the financials. Financials also, if you trade trends, hopefully you sold when it broke this accelerated trend, when it lost a 21-day. I typically stay in portfolio approach when things follow their 8 and 21-day. My process says switch gears, and that happened right around here. Then what did it do? It hovered on this trend line, broke below it, 200 days right there. Yesterday's low is 2050. Write that down. Goldman Sachs has been really weak. See if that could find muster a bounce. Look at that, the weakest one out there, below the 200-day. Yesterday's low is 159.77. This gave you some clues that this market was that weak. Okay, so from there, let's just talk a little bit about some stocks. Typically, what we've seen in the last week or so with the volatility, every time the futures have been down big, there's been some stocks that go green tactically for cash flow. With that being said, these strong stocks become go-to status, but the deeper that this correction goes, they sometimes give way. So you really need to know why you're trading them. So at this particular point, there are some standouts. First of all, I just want to talk about cores. Great numbers, hit the ball out of the park, right back at highs. So it's showing you that, if you are a stock picker and you love cores and you said that people are shopping there through the holidays, this is an unbelievable play, boom, you're getting rewarded if you still own it. Technically, didn't really show you much except for most of retail is below the 150-day or below the 200-day, so it showed you relative strength. And now, see if it could open up above the 85 and stay above it. I would just wait for that gap and give it a few days if you're not in there. But just to show you, cores in retail above the 150 and the 200-day, look where the RTHs are. RTHs are at the 200-day. So that stock is showing you relative strength to the group, so that at least that was somewhere, if you had to be in a name, cores was one of them. With that being said, let's move on. Facebook. Hey, happy birthday, Facebook. 10 years old. Just want to show you, this is really why the stock market is here. Investment bankers made money. Private placement people made money. Investors that bought this cup and handle made money. Traders who follow the relative strength rules probably made money. So great vehicle for America to make money with if you had a process to deal with it. As of now, for me, this stock has had earnings. It's been stronger. And if you're involved in it, basically I'd say stay involved as long as it holds this earnings gap. A little wishy-washy yesterday. It's up a little bit. I would say use this as your stop. The low here is 60.17. And then at some point, if we do get a bounce, this should be the first stock, in this arena to make new highs. Got to point out Zynga. Zynga all of a sudden, boom, back to life. It spun off some units, it got rid of some people, blah, blah, blah. I guess Zynga's a new safety stock, which I'm only kidding. But either way, big gap up, held, showed relative strength yesterday. I know Sperling's been talking about this one for a long time. It's now above 450. I think it got a price target by UBS up to 6. And if you're in it still and you just held it in your drawer, congratulations. You might make some money there. Twitter is also acting well. But again, we have to deal with earnings. Earnings are going to be out, I think, Wednesday after the close. So it could be, who knows what exactly they're going to say and how the street's going to take it. But ultimately, above the moving averages, acting well. LinkedIn is on Wednesday. LinkedIn's been in a corrective phase for quite some time now. Okay, if you look at LinkedIn, it's had an enormous run, okay, from way back here. And this has been pretty, controlled to the downside. So with that being said, if you want to take risk into earnings and you're looking to do some kind of options, I would say maybe do a call spread where you buy the 220s and you sell the 235s if you want to be involved for potential upside surprise, which I don't know if it's going to happen. There's some big, I think they're going into China and there's still some potential. I know a lot of people still use it, but LinkedIn's, maybe it has differentiated itself from social as far as Facebook and Twitter, where it turned into more of a job site / professional networking, not really something people use, just to post pictures and say hello to mommy and daddy or talk to financial people around the world. But anyway, that's your level, 230 there. As far as Apple's hanging around. I'm not that interested in it. They're talking about this new network, which could be something leading into their Apple TV. All in all, yesterday it tried to be a little strong before giving way. You still have this lower pivot. If it were to get above, I guess, 507 and hold it for like 60 minutes, maybe you get a move to fill partial of this gap here. I'm not in it and haven't really traded it since earnings. Some people bought it on the red dog reversal right here. If you did so, hopefully you sold a little bit yesterday, and if you still have some trailing it versus low, you're still there. At some point, maybe it tries to get into the earnings gap for a trade, but at this point, I wouldn't be over trading this one. Netflix still go-to status, acting well, held the earnings gap, a little testy right there, but now still going sideways. If you long this one, be long versus just say, 398 or even just say 402-ish. 402-ish is your high-level stop, but it's getting a little wishy-washy in here, so be careful. And with that being said, there's not really that many great setups out there. In this type of oversold tape, the setup that I look for is that red dog reversal that I went over with the sectors with you. But you could use that in any stock that's been down huge. Instead of trying to catch a falling knife, let it break a prior low or hold versus it, and then once you come back above it, buy for a tactical bounce. Sometimes it's a great swing trade. Sometimes it's just a great cash flow day and a half trade. Sometimes it only works for 15 minutes. So with that being said, I don't think personally, but what do I know, that this is 2008 where we're going to be down 50% this year. I think that, we're in this corrective process. I think, we're closer to the end than the beginning of it. And at this point, if you made some adjustments at 1830 in the S&P or yesterday, you have the opportunity to embrace the volatility, make some trades, stay tactical, and if we get some kind of bottom process, perhaps we could put on some, positions more than a few to ride a bounce or ride further than that if we do see some kind of bottom process. But the news hasn't been good. You have inflation, creeping up. You have data points going lower. Some are blaming it on the weather. Maybe that's the truth, considering January was considered the coldest month in a century. So with that being said, we start warming up. The numbers could start getting better, but who knows? That could be in a month or 2 months from now. So how long? They're not really giving that excuse a pass. You have Yellen this week. We have the jobs number on Friday. You have ADP Thursday. The BOE on Thursday. Also, a lot going on. So we'll see. Hopefully you're in a good position. You're thinking straight. You're not frustrated. You have your plan, and just execute on it. If you have a plan and you don't execute, it's not really that great. If you said yesterday, I'm getting out of my risk if we break 177. And you didn't do it, how well did you do? If you said yesterday, I missed a short from 183 to 177, I want to catch it from 177 to 174, and you didn't do it, how well did you do? So have a plan, execute it, or execute on it, even if it's only a small amount. So this way, you start feeling good, so when you do see things, you could actually push those buttons, make some money, and continue to make progress. Scott Rella, T3 Live, The Morning Call. See you to recap. Have a great day trading.